What if I told you that by investing just $10 a day, you could potentially turn it into $1 million over time? Sounds too good to be true, right? Well, today we're diving into exactly how that can happen with SPY, one of the most popular ETFs in the world, and the power of compounding. Actually, any good S&P 500 index fund will do the same. We're just using SPY as an example. So this isn't financial advice telling you to go buy SPY. Do your own homework, do your own research, but this is to show you how compounding works when properly invested. I'm going to break down a real strategy that could take your small daily investments and grow them into something extraordinary. Whether you're new to investing or looking to maximize your current strategy, you're in the right place. So let's get started. Welcome back to Simply Money. Today we will be looking at how just small steps, how small changes can impact your future drastically. A lot of people I hear talking, I'm going to start saving, I'm going to start investing, but first I need to make more money. First I need to take care of some things. But time is of essence. Time is the biggest factor in compounding. And I'm going to show you just exactly how that works here in a moment. So here's some of the premises we're going to use. If you invested $10 a day, each day the stock market is open. That's approximately 252 days per year, which works out to about $210 per month. So if you were to take that $10 each day, invest it in the stock market. Now, again, you could do it once a month and just invest $210, or maybe you get paid biweekly and want to do $105 per paycheck. It doesn't matter. It's going to come out to about the same because you're still dollar cost averaging. You're taking the same amount of money and you're investing it on a consistent basis. So you're getting some days when you're buying, the market's a little higher. Some days when you're buying, it's a little lower. So it averages out that you're not always buying at the high or you're not always buying at a low. And this is how dollar cost averaging works over years. So the consistency is what we're looking for. But in our example, we're using $10 a day. Each day the stock market is open. We're assuming the historical return of SPY, an S&P 500 index fund, which is about 10.2%. We're going to go with 10% as the historical return to future growth potential. Here's what it's going to look like. You take your $10, you invest it each day, and what does it look like at the end of 5 years? Right here, you can see 5 years, you've invested $12,600. Your future value now is $15,385. So you have earned $2,785 of growth. Now, again, this is assuming that we're reinvesting the dividends, which is on average 1.2% with SPY. So the quarterly dividend that is paid is being reinvested into SPY. At the end of 5 years, you've only earned under $3,000. And this is where people will sit there and say, it's just not worth it. I'm investing. I could use that $210 a month now to enhance my lifestyle, to buy a nicer car, to put toward entertainment, whatever the case may be. You're sitting there saying, right now, my present is so much more important than my future. But when you're 70 years old, you're going to look back at your younger self and be like, oh, that money I wasted on all those things would be so beneficial now. And the compounding it could have received from being invested from an early age. So 5 years, you don't see a huge change because investing isn't about short term. It's a long-term strategy. The strategy I adhere to is buy and hold. I'm investing in something, I'm buying, and I'm holding it for long term. This isn't a rainy day fund. This is a rainy life fund. This is my older self fund. I'm 65 years old, 70 years old. How am I going to support myself? How am I going to take care of myself? This is that fund that needs to start early because compounding is of essence. Time is your greatest ally when it comes to investing. And so 5 years, we don't see a huge amount. We don't see a huge compounding impact, but we are seeing some. You can see as the compounding takes hold a little bit, we go from making $250 to we're up to $2,700. But let's go down here to 10 years. So we've doubled the time, we've doubled the amount we've invested. Now we've invested $25,200. Now our future value is $40,000. We have grown that $14,000. Now we're starting to see this a little bit and we're thinking, hey, $40,000, that would be nice to have invested. That would be a great start to my portfolio and beginning to grow. This is beginning to be okay. This is with $10 a day on the days the stock market is open, $210 a month. You're seeing your growth up to 40,000. Now, this is why starting early is important. We're going to go into that here in a minute. But now let's go and double it again. Let's go to 20 years. But 10 years, you see that you're at 40,000. At 20 years, we've invested 50,000. Now we're up to $144,000 with 93 of that, almost 94 of that being growth. Now we're seeing some compounding. Now we're saying, hey, I have basically tripled my value by investing and holding, but it gets better. This is where if you're young and you can start, it is so powerful. Now we're going to go back. Maybe you're 55 and you're like, I don't have much time until retirement. I can't save anymore. Look what an extra $210 a month can do. That's a big difference. That can give you that little cushion you need. That can be that emergency fund if the market's really down one year and you need to have an extra little bit to get you through a year. This amount is nothing insignificant to help leverage your account, and that's by $210 a month. It's never too late. But if you're young, say you're 45 and you got 20 years until you're going to retire, you can add an extra $144,000 to that retirement by $10 a day. But for you younger folks, let's say you're 35, you invest that $210 a month, that $10 a day. That $75,000 you have invested has now grown to $414,000. The growth of that is $338,000. See how that next 10 years, that is what compounding has done. That snowball, where it took you 18 years to get to 100,000. It took 5 years to get to the second 100,000, 4 years to get to the third, 3 years to get to the fourth. That's compounding. That $100,000 that took you 17, 18 years to get to, now you're getting $100,000 in 3 years because you started younger. Just imagine if you're 25 years old and you start now, instead of that 55-year-old who starts and they only get to that $40,000 mark, you're 25. So from 55 to 65 would be like from these 30 to 40, you're going from 400,000 to $1.1 million. What took 10 years to get to 40,000, now 10 years gets you $700,000. That is the amazing compounding effect. At 40 years of investing, you have put away $100,000. $10 a day for 40 years, but consistent. That is the key. I am a consistent investor, dollar cost averaging, day in, day out. I am making that commitment to my future self, and it has grown to $1,115,000. $1 million of that has been the growth. Look at that growth. You have 10-folded your investment. That is time. We could run this down. Maybe you wait until you're 75, what that would grow to. You could imagine what that would be. But we're not going to get into that because most people aren't waiting until they're 75. Most people aren't starting when they're 15, whatever the case might be. Most people have 30 years, 40 years to 30 years or 40 years to plan for retirement. Take advantage. If you are young, take advantage. Even if it's $5 a day, start now. And as you increase your income, as you decrease your expenses, you can add more to that. But start. The whole point of this is consistently adding in to your portfolio and watching it grow. So, yes, $10 can turn into $1 million if you are strategic and you're consistent. So, that's it for today. If there's a dollar amount you'd like to learn or you'd like to see on a chart, maybe you say, okay, I've done my budget. I can afford $7 a day. What would that look like? I'd be glad to run that and do a video just for you. Send me a comment down below. Let me know what you think. Give me your thoughts on this. Good, bad, ugly, whatever it is. I'm open to hear your feedback on what you think about this, because I think it's important to be consistent and start small, and you can always increase it later on. But take advantage of every day you have, and today's your day to start your journey to financial freedom. Hit that like and subscribe button, and we'll see you next time on Simply Money.